In this video, traders are looking at spread betting financing rates. How does it work? Stay tuned. Hey guys, a warm welcome to you. Alright, so spread betting, very useful vehicle for shorter term traders, but is it useful for holding over a period of time? Yes it is, but you have to be aware that for every day you hold the trade, you are being charged a financing rate. Now, it's worth pointing out that there are some instruments available on many spread betting platforms that have a wider spread that don't have an overnight charge, like a futures contract on the indices, like a forward on the currencies. However, if we're looking at an equity trade, for example, if we're going long Marks and Spencer's, Tesco's, Vodafone, HSBC, Apple, Facebook, anything like that, then you're going to be charged a fee, an overnight holding fee to carry that trade over. Now, this is only charged at 5 p.m. Eastern time, 10 p.m. UK time. So if you're trading intraday, you're not going to be charged at all. You could have a £1,000 position or £1 million position. If you've closed that intraday, no fee is charged. In other words, if you closed it before the close of the stock exchange on that day, well, actually, officially, if you close it before 10 p.m. GMT, but if you're trading in equity, the actual close is obviously the bell of the exchange, whether it's the New York Stock Exchange, which is 9 p.m. UK time, or whether it's the London Stock Exchange, 4:30 UK time. So if you're trading in and out intraday, there's no fee, it's just the spread that you're paying. However, if you're holding that position, looking for a multi-day move, for example, you're going to be charged an overnight fee. So how does that work? Let's have a look at an example of an equity. So you're fundamentally, guys, you're charged LIBOR. Most of the time it's LIBOR, sometimes it's slightly different, plus a fee. In other words, what matters is there's an interest rate, an annual interest rate applied to trade each specific instrument, and each instrument is different. Not necessarily, because some equities might well be the same because you're being charged in GBP, but if you're trading, let's say FTSE, and you're trading DAX, you're trading Euro US dollar, then they're all going to be and they're all calculated slightly differently, obviously based on the current rate of the interest rates in that country. If you're trading a currency pair, it's the difference between the two. If you're trading UK share, it's LIBOR plus a fee. And this is the important bit. There may well be, a low interest rate, but this is how the spread betting companies are making their money. Okay, they're making their money by that fee, which is fair enough, right? You're using them as a business, right? You're expecting to make money, making money from the spread and making money from that fee. So LIBOR plus a fee, or differential between the interest rates of your currency plus a fee. The point is there's an annual interest rate applied and it's divided by 365 to give you your daily charge. So every day you'll charge that annual rate divided by 365. So every day that is debited from your account, or the price. Sometimes in some spread betting firms, they'll adjust the price that your trade is at. So they'll adjust it to allow for that charge. Sometimes they'll take the charge off, sometimes they'll adjust it, depends on who you're trading with. So, and also worth pointing out, guys, that on the short side, if you're trading on the short side, you will receive LIBOR plus a fee. Now, in low interest rate environments, that's going to mean that you're still being charged to place a trade, to hold a short trade overnight. But in high interest rate environments, if LIBOR is high and you're receiving it, let's say it's 5% and the fee is 2.5%, you're going to receive 2.5% for holding that trade overnight. But at the moment, with low interest rate environments, you're going to be charged whatever you're doing. So the important thing, guys, to remember, an easy thing to remember, is you're just charged an annual rate that's divided by 365 to get your fee. So how does that work in the real world? So, and what are you charged on? So let's say we're in this share trade here, UK equity currently trading at 415 pence, right? We go long, £10 a point, spread betting account, great. Now, at the end of the day, that's lifted up, and at the end of the day, closing price is 450. So that's the mark that we're going to be charged on. We're going to charge on that 450, not the entry price. It's the closing price that matters, because that's the current notional value, or how we can work out the current notional value of our trade. And how do we work out the notional value? The notional value is our position size multiplied by the actual price that we closed at. So £10 a point times 450 is equal to £4,500 notional value. That's the notional value of our trade. And so how do we work that out from there? Well, we go, right, okay, if it's 450 times £10 a point notional value, we then go, right, times 3.5% to get our annual interest rate, divided by 365 to get our daily charge. Our daily charge is going to be 43 pence per day. Not a lot. However, when we start getting into bigger notional values, which when we're trading stuff like the indices, because the indices, we have to have a bigger position because they're not swinging as much generally as shares. So that notional value could well be something like £45,000. Because if you can imagine, you're in £10 a point, let's say an index is 4,500, for example, quite a feasible level for an index, it's going to be 10 times as much as that. So you're looking at a £45,000 notional value. You're going to be charged a little bit more per day, £4 per day to hold that trade, and going up and up and up, as you can see. So it's important about the notional value, which is why that a lot of spread betting firms allow you to trade a forward contract or a futures contract. So if you're trading for many, many days, you can trade something a little bit more efficient. But if you're trading shares, this is how the charge is calculated, 43 pence per day for that. You can work it out yourself and you can see how the whole thing works. All right, guys, take care. See you in the next one. Bye-bye.